In 1997, one man placed a $10 billion bet that destroyed 5 nations, not with armies, not with bombs, with currency speculation. George Soros, controlling a hedge fund called Quantum, attacked the Thai baht. Within days, Thailand's economy collapsed. Within weeks, the crisis spread like a financial plague across Southeast Asia. Indonesia, South Korea, Malaysia, the Philippines all fell like dominoes. $1 trillion in wealth evaporated. Entire economies imploded. Millions lost their jobs, their savings, their futures. Governments that had seemed stable for decades were brought to their knees, forced to beg the International Monetary Fund for survival. And the speculators who triggered the crisis? They walked away richer. George Soros himself reportedly made over $1 billion. Wall Street hedge funds made billions more. They didn't build anything. They didn't create value. They simply bet that currencies would fail, and then made them fail. This is the story of how financial markets learned they were more powerful than governments, how speculators discovered they could break entire nations with nothing but leverage and timing, and how the playbook they wrote in 1997 is still being used today to transfer wealth from the many to the few. If you think governments protect you from this kind of attack, you're about to discover why markets don't care about sovereignty. This is The Financial Historian. Let's talk about the day Wall Street broke Asia. Before we understand what happened in 1997, you need to understand how a currency attack works, because this isn't some complex financial wizardry. It's a con game scaled up to nations. Here's the setup. Many countries peg their currency to the US dollar at a fixed exchange rate. Thailand, for example, kept the baht fixed at roughly 25 to $1. The government promised that rate would hold, and they backed that promise with foreign currency reserves: dollars, euros, yen held by the central bank. The peg creates an illusion of stability. Businesses can plan, investors can predict returns, international trade flows smoothly, but it also creates a target. Because here's the trick: maintaining a currency peg requires constant intervention. If investors start selling the local currency, the central bank must buy it back using their reserves. If everyone starts selling at once, the reserves run out. And when reserves run out, the peg breaks, the currency collapses. Now imagine you're a hedge fund manager with billions of dollars to deploy. You look at Thailand in 1997. The economy has some problems: too much borrowing, a real estate bubble, slowing exports. The currency is overvalued. The central bank's reserves are large, but not infinite. So you make a bet. You borrow massive amounts of Thai baht and immediately sell them for dollars. You're not holding the baht because you want it. You're selling it because you think the value will fall. If you're right, the baht collapses. You buy it back at the lower price, return what you borrowed, and pocket the difference. If you borrowed 1 billion baht when it was worth $40 million, and you buy it back after the collapse when it's worth only 20 million, you just made 20 million in profit. But here's the evil genius of it. By selling massive amounts of baht, you're not just betting on collapse, you're causing it. Your selling forces the central bank to spend reserves defending the peg. And if you're big enough, and if other speculators see what you're doing and pile on, you can drain those reserves until the central bank gives up. This is not a prediction. This is an attack. You're using leverage to force a government's hand. And the bigger you are, the more damage you can do. George Soros had done this before. In 1992, he famously broke the Bank of England, forcing Britain out of the European exchange rate mechanism and making over $1 billion in the process. He proved that even powerful, developed nations couldn't defend their currencies against a coordinated speculative assault. By 1997, Soros and other hedge funds were looking for the next target, and they found it in Thailand.
In the early 1990s, Thailand was an economic miracle. GDP growth was averaging 8 to 9% per year. Bangkok was booming. Foreign investment poured in. The country was building skyscrapers, highways, shopping malls. The Thai baht, pegged to the dollar, seemed rock solid. But underneath, the foundation was cracking. Thai companies had borrowed heavily in dollars, thinking the peg would hold forever. Real estate prices had soared into bubble territory. Exports were slowing as the dollar strengthened, making Thai goods more expensive abroad. and the central bank was defending an overvalued currency. Speculators saw the weakness. In early 1997, hedge funds began testing Thailand's defenses. They started selling baht, forcing the Bank of Thailand to spend reserves to buy it back and maintain the peg. At first, Thai officials were confident. They had about $30 billion in reserves. They publicly vowed to defend the baht to the last bullet. They even raised interest rates to make holding baht more attractive, hoping to stop the selling. But raising rates made things worse. Higher interest rates crushed businesses that had borrowed money. Bankruptcies spread. The real estate bubble burst. Investors panicked and started pulling money out of Thailand faster. George Soros and his quantum fund went for the kill. They borrowed and sold billions of dollars worth of baht, betting the peg would break. Other hedge funds saw the opportunity and piled on. The selling pressure became overwhelming. By July 1997, the Bank of Thailand had burned through most of its reserves and was nearly out of ammunition. On July 2, they surrendered. The government announced it was abandoning the peg and letting the baht float. The currency collapsed instantly. Within months, the baht lost more than half its value against the dollar. What had been 25 baht to $1 became 50, then 60. Think about what that means. If you were a Thai company that had borrowed $1 million, you now owed twice as many baht to repay that loan. If you were a Thai family with savings in baht, your purchasing power for imported goods was cut in half overnight. Thai businesses that had borrowed in dollars couldn't repay their debts. Bankruptcies exploded. Unemployment soared. The stock market crashed by more than 75%. The economy, which had been growing at 9%, contracted by more than 10%. Thailand went from miracle to disaster in a matter of months. And the crisis was just beginning. Currency crises are contagious. Once Thailand fell, speculators looked around and asked, who's next? The answer was everyone with a similar setup. Indonesia, Malaysia, the Philippines, South Korea. All had currencies pegged or managed against the dollar, all had borrowed heavily in foreign currency, all had vulnerabilities. Investors didn't wait to find out if these countries were actually in trouble. They assumed they were and started pulling money out. It was a self-fulfilling prophecy. The fear of collapse caused the collapse. Indonesia was next. The rupiah, which had been stable for years, came under attack. The central bank tried to defend it, failed, and the currency collapsed by 80%. 80%. If you had savings in rupiah, you lost 4/5 of your wealth in months. Indonesian companies that had borrowed in dollars were instantly bankrupt. The banking system imploded. Riots broke out as food prices skyrocketed. The government fell. President Suharto, who had ruled for 3 decades, was forced to resign. The country descended into political and economic chaos. South Korea fell next. One of Asia's strongest economies, home to Samsung, Hyundai, and other global giants, couldn't stop the panic. The won collapsed. The stock market crashed. Major conglomerates went bankrupt. Unemployment tripled. Korea, which had been seen as a model of development, was reduced to begging the IMF for a bailout. Malaysia and the Philippines followed the same pattern. Currencies collapsed, economies contracted, savings evaporated. The entire region was on fire. By the end of 1997, 5 nations had fallen. Stock markets across Asia had lost trillions in value. Currencies had collapsed by 50, 60, even 80%. Unemployment was soaring. Governments were collapsing. And the speculators who had bet against these currencies? They were counting their profits. This wasn't an accident. This wasn't bad luck or a natural disaster. This was a coordinated attack by hedge funds that realized they could profit by destroying economies. They didn't care about the human cost. They cared about the returns. George Soros later defended his actions, saying he was just a participant in markets, not the cause of the crisis. He argued that these countries had bad policies and the collapse was inevitable. Maybe. But when you borrow billions, sell currencies you don't own, and force central banks to exhaust their reserves, you're not just participating. You're attacking. And when you walk away with $1 billion in profit while millions lose their jobs and savings, you're not a victim of circumstances. You're a beneficiary of destruction. When the crisis hit, Asian governments had nowhere to turn. Their reserves were gone. Their currencies had collapsed. Their economies were in free fall. They needed emergency loans to stabilize, to avoid complete collapse. Enter the International Monetary Fund. The IMF, funded primarily by the United States and Europe, stepped in with tens of billions in loans. Thailand got 17 billion. Indonesia got 40 billion. South Korea got 58 billion. But the loans came with conditions. Brutal conditions. This is where the real theft happened. The IMF demanded what it called structural adjustment, a polite term for gutting the social safety net and opening the economy to foreign ownership. Governments had to slash spending, even as their people were suffering. They had to raise interest rates, even as businesses were failing. They had to sell off state assets, banks, utilities, industries, often to foreign investors at fire sale prices. Let that sink in. These countries, at their weakest moment, were forced to hand over their most valuable assets to foreign corporations for a fraction of their worth. Wall Street banks and multinational corporations descended like vultures. They bought Indonesian banks for pennies on the dollar. They acquired Korean conglomerates for fractions of their value. They snapped up real estate, infrastructure, and industries. The same speculators who had profited from the collapse were now buying the wreckage at bargain prices. It was the perfect crash the economy, then buy the pieces for cheap. And the IMF justified this by saying it was necessary to restore confidence and discipline. As if the problem was that Asian governments hadn't been punishing their people enough. Meanwhile, the human cost was staggering. In Indonesia, poverty doubled almost overnight. In Thailand, millions lost their jobs. In South Korea, families that had been middle class were suddenly destitute. Suicide rates spiked. Malnutrition spread. Children dropped out of school because their parents couldn't afford it. Entire neighborhoods were displaced as property was seized by creditors. And through it all, the IMF and Western banks lectured about moral hazard and free markets. They insisted that the pain was necessary, that Asia had to learn fiscal discipline. But notice who paid the price. Not the speculators who triggered the crisis. Not the banks that made risky loans. Not the foreign investors who bought assets at fire sale prices. The cost was borne by ordinary people, workers, families, small business owners. People who had done nothing wrong except be born in countries that became targets. This is the pattern that repeats in every financial crisis. The insiders profit, the outsiders pay. The system is designed to transfer wealth upward, and crises are the most efficient transfer mechanism ever invented. Let's be precise about the winners and losers, because the wealth transfer was not subtle. The losers. Ordinary Asians. Thai workers who lost their jobs when factories closed. Indonesian families whose savings were cut by 80%. Korean employees laid off as conglomerates collapsed. Middle-class families across the region who had worked their entire lives to build security, only to watch it evaporate in months. Suicide rates in South Korea doubled. In Thailand, child labor increased as desperate families pulled kids out of school to work. In Indonesia, the percentage of people living in poverty went from 11% to nearly 20% almost overnight. The winners. George Soros and his quantum fund reportedly made over $1 billion shorting Asian currencies. Other hedge funds made billions more. Wall Street investment banks collected fees for managing the crisis and advising on restructuring. And then came the real payday, buying assets at fire sale prices. Western banks and corporations acquired Asian banks, real estate, and industries for fractions of their pre-crisis value. Let me give you a specific example. The Siam Commercial Bank, one of Thailand's largest banks, saw its stock price fall 90% during the crisis. Foreign investors, using loans from the very IMF that was supposed to be helping Thailand, bought up the bank at the bottom. When the economy eventually recovered, those investors made fortunes. This wasn't just opportunistic. This was the design. Crash the market, force the government to privatize, buy the assets cheap, wait for recovery, profit. And here's the kicker, many of the Asian companies and banks that were bailed out ended up controlled by foreign interests. The crisis didn't just destroy wealth, it transferred ownership from local hands to global capital. Asian governments, desperate for stability, had no choice but to accept the terms. The IMF made it clear. Take the loans with conditions, or collapse entirely. So yes, Asian economies eventually recovered. But the recovery looked different. Foreign ownership increased dramatically. Inequality widened. The middle class was hollowed out. And the speculators who caused the crisis walked away richer. If you think the 1997 Asian financial crisis is just history, you're not paying attention. The playbook written in that crisis is still being used today. Currency attacks haven't stopped. They've evolved. In 2015, speculators attacked the Chinese yuan, forcing China to burn through hundreds of billions in reserves defending its currency. In 2018, Turkey faced a currency crisis as the lira collapsed by more than 30% in months. Argentina has suffered repeated currency crises, most recently in 2018 and 2019. And the United States? The dollar's dominance makes America seem immune. But that dominance is also what makes it the ultimate target. Right now, the US dollar is the world's reserve currency. Most international trade is denominated in dollars. Most central banks hold dollars as reserves. This gives America enormous power, the ability to print the world's money, to borrow cheaply, to sanction other nations. But it also creates vulnerability. The dollar's strength depends on trust that the United States will maintain fiscal discipline, that inflation will stay low, that the currency won't be weaponized. That trust is eroding. The U.S. national debt exceeds $36 trillion. The Federal Reserve printed trillions to cover deficits. Inflation, which officials insisted was transitory, has become persistent. And America has increasingly used the dollar as a weapon, sanctioning Russia, China, and other nations. This is dangerous. Because when you weaponize the reserve currency, you give other nations an incentive to find alternatives. And they are. China and Russia are trading in yuan and rubles, bypassing the dollar. Saudi Arabia is discussing pricing oil in currencies other than dollars. The BRICS nations, Brazil, Russia, India, China, South Africa, are building alternative payment systems. If the dollar loses reserve status, America faces the same crisis Thailand did in 1997. Except on a far larger scale. Imagine a coordinated attack on the dollar. Foreign central banks, sovereign wealth funds, and hedge funds simultaneously selling dollars and U.S. Treasury bonds. The currency would collapse. Interest rates would spike. The cost of servicing America's $36 trillion debt would become unpayable. The economy would implode. Sound far-fetched? It's already being discussed. Chinese and Russian officials have openly talked about reducing dollar dependency. Middle Eastern nations are exploring alternatives. The infrastructure for an attack is being built right now. And just like in 1997, the people who will pay the price won't be the speculators or the elites. It will be ordinary Americans whose savings are in dollars, whose pensions are in treasury bonds, whose wages are denominated in a collapsing currency. So how do you protect yourself when the world's financial system is a battlefield and your country could be the next target? First, understand that currency is a tool, not a store of value. The dollar, the euro, the yen, these are all just paper backed by promises. When the promises break, the paper becomes worthless. Real wealth is assets that hold value independent of government promises. Second, diversify across currencies and jurisdictions. Don't keep everything in one currency or one country. If you can, hold assets denominated in multiple currencies. If the dollar collapses, you need options. If one system fails, you need access to another. Third, own real assets. Real estate, if you can maintain it. Commodities that have intrinsic value. Productive businesses that generate income. Skills that let you create value regardless of what happens to currencies. These are what survive when financial systems break. Fourth, recognize the warning signs. When a currency is under attack, it doesn't happen in secret. Reserves start falling. Interest rates spike. The government insists everything is fine while capital flees. If you see these signs in your country, move assets before the doors close. Fifth, don't trust the rescuers. When the IMF or other international institutions arrive with loans, they're not there to help you. They're there to protect creditors and extract value. The rescue is often worse than the crisis because it locks in permanent wealth transfer. The 1997 Asian financial crisis taught us that markets are more powerful than governments. That speculators can break nations. That international institutions serve the powerful, not the people. And that when crisis comes, ordinary citizens pay while elites profit. These lessons aren't just history. They're the operating manual for the financial system you live in today. And if you don't understand them, you'll be one of the millions who watch their savings evaporate while others get rich from the chaos. In 1997, George Soros bet $10 billion that he could break Thailand. He won. Thailand's currency collapsed, the economy imploded, and millions of people lost their jobs and savings. The crisis spread. Indonesia, South Korea, Malaysia, the Philippines, 5 nations fell in months. $1 trillion in wealth evaporated. Governments collapsed. Riots erupted. Suicide rates doubled. And the speculators who triggered it? They walked away richer. Soros made over $1 billion. Wall Street made billions more. Then they bought up Asian banks and industries at high sale prices while the IMF forced governments to sell their assets. This wasn't a natural disaster. This was financial warfare. Hedge funds realized they could profit by destroying economies, and the playbook they wrote in 1997 is still being used today. China, Russia, and others are building alternatives to the dollar. The infrastructure for an attack on American currency is being assembled right now. And when it comes, the people who will pay won't be the elites with offshore accounts and diversified assets. It will be ordinary Americans whose savings are in dollars, whose pensions are in treasuries, whose wages are denominated in a currency that could collapse just like the Thai baht did. Markets don't care about sovereignty. Speculators don't care about human cost. And international institutions serve creditors, not citizens. The 1997 crisis proved that no nation is safe when financial markets decide to attack. The only question is whether you'll see it coming in time to protect yourself. History doesn't repeat, but if you ignore it, it will crush you all the same. If this gave you a new perspective, hit subscribe. History has the answers, I'll show you where to look.